All right, let's get right to it. Most people, they're glued to the stock market. But you need to know, the real story for 2026, it's the one nobody in the mainstream is talking about. And this isn't some doomsday crash scenario. No, this is about a calculated systemic reset. And this is your survival briefing.
Okay, I want you to burn this number into your brain. $9 trillion. Why? Because it's the key to everything that's coming. Think of it as this invisible wall the entire U.S. economy is about to slam into. That's the mountain of short-term government debt that has to be refinanced. And here's the kicker, it's not with the cheap, easy money of the past. Nope, it's got to be rolled over at today's much, much higher interest rates.
So here's how we're going to break this down. First, we'll tackle the problem head-on, that $9 trillion wall I just mentioned. Then, we'll get into the fallout. Who's stopped buying our debt, and more importantly, who's now being forced to buy it. We'll connect the dots on what that means for the dollar. And then, the most critical part, we're going to get into your personal solution. We're calling it the survivor's strategy.
Now, I need you to be really clear on this. What we're talking about here, it isn't some wild theory or speculation. It's just cold, hard math. A math problem with a very real deadline. We've got about $9 trillion of U.S. debt, all borrowed back when money was basically free. And guess what? It's all coming due. The Treasury? Well, they can't just pay it back. So their only move is to refinance it at today's sky-high rates.
Look, the numbers on this chart are they're staggering, right? But just focus on that bottom line. The annual interest payments alone have now crossed $1 trillion a year. Let that sink in. That's $1 trillion that doesn't build a single road, fund any research, or pay for any services. It's just gone. It's the ghost of past spending. And believe me, that ghost is about to get a whole lot bigger.
And this is where you really see the trap snap shut. To roll over that old debt, the Treasury has to issue new bonds at higher rates. Simple enough. But those higher rates mean higher interest costs for the government. And what do higher interest costs do? They blow up the budget deficit. And how do you cover a bigger deficit? You guessed it, you have to borrow even more money. It's a perfect, vicious feedback loop.
For decades, this whole system kind of worked. It limped along because there was always this line of willing foreign buyers for U.S. debt. They were like the shock absorbers for the whole system. Well, that's changing, and it is changing fast. Those shock absorbers, they're failing.
Just take a look at this timeline. China's move here isn't some knee-jerk reaction. This is a deliberate, decade-long strategic walkout. They peaked back in 2013, holding $1.3 trillion of our debt. Since then, they've methodically chopped that in half, and now, in 2026, they've taken the next step, telling their own private banks to get out. See, this is the critical point. They aren't just selling, they are exiting the entire system.
In this chart right here, this is the result. Foreign investors used to own almost half of all U.S. public debt. Now, it's down to less than a third. So you see the problem, right? The U.S. government's deficits are getting bigger, meaning they need more buyers than ever, right at the exact moment their biggest customers for decades are heading for the exits.
So that's the million-dollar question, or I guess the trillion-dollar question. Who's going to fill this massive buyer gap? Well, economist Peter Schiff puts the uncomfortable truth out there. The buyer of last resort is going to be the Federal Reserve. And let's be crystal clear about what that means. That's not a real transaction. That is just a fancy term for printing money out of thin air. And it has one direct result. The value of your savings gets destroyed, and prices for everything you buy go through the roof.
Okay, so with the foreign buyers walking away, the government is cornered. They've been forced to turn inward. To fill that massive void, they're basically leveraging our own financial system to soak up all the debt that foreigners don't want anymore. There's a name for this, and it's called domestic absorption.
Yeah, and this term is absolutely key to understanding what's happening behind the curtain. Domestic absorption. It's how a government props up its own debt market when no one else will. They use regulations, they use political pressure, whatever it takes to create a captive audience of buyers. It's effectively forcing the entire nation's savings into government bonds.
So who exactly is in this captive audience? Well, number one, U.S. commercial banks. They're basically required by regulations to hold these quote-unquote high-quality assets. Then you've got pension funds and mutual funds. And maybe most frightening of all, you have the Social Security trust funds, which, by the way, are already almost broke, and they're being forced to hold trillions of this stuff. It's literally the snake eating its own tail. You're taking money away from the real, productive economy just to keep the government spending machine running. And this forced buying leads to something really dangerous called the bank trap. See, these banks were pushed into buying trillions in bonds when interest rates were at zero. Now that rates are way up, those old bonds are, well, they're underwater. They're worth way less. The banks are trapped. They can't sell them because if they did, they'd have to book massive losses that could wipe them out. You remember Silicon Valley Bank? That was just a tiny preview. The systemic risk we're talking about now is on a whole different level.
So when you tie all these threads together, the huge refinance wall, the foreigners leaving, this domestic trap, it all leads to one single inevitable endgame. It's a state known as fiscal dominance. And that's the point where the government's debt gets so big, so out of control that it completely dictates what the central bank can and can't do.
And in this endgame scenario, the central bank completely loses its independence. It's game over for that. They literally can't raise interest rates to fight inflation anymore, because if they did, the interest payments would bankrupt the government. So their main job shifts. It's no longer about protecting your purchasing power. It's about making sure the government can keep paying its bills. This is the moment the debt becomes the master and the central bank becomes its servant.
I mean, the logic here is just inescapable. Let's walk through it one last time. 1. The $9 trillion wall hits, forcing higher interest rates. 2. Those higher rates make interest costs explode, blowing out the deficit. 3. The Treasury has to issue even more debt to cover that hole. 4. The well of real buyers both here and abroad runs dry. They're tapped out. And that leads to step 5. The Federal Reserve is left with absolutely no choice. It has to step in and print money to buy the debt. That's debt monetization. That's the definition of currency debasement.
So, okay, that's the anatomy of the crisis. It's bleak, I know. But here's the thing. Every crisis also creates an opportunity, but only for the people who are actually prepared. The absolute key is to understand how to protect yourself. And that requires a massive shift in how you think about your wealth, a move away from paper promises and towards real, tangible assets.
Think about it. What are paper assets? Stocks, bonds, even cash in the bank? They're all just promises to pay you later. They all depend on a system that, as we've just seen, is under incredible stress. They can be inflated away to nothing. But hard wealth, things like physical gold and silver, that's different. These are real, tangible things you can hold in your hand. They exist outside that failing system. They don't rely on anybody's promise, and they have been a reliable store of value for what, 5,000 years?
And if you remember one thing from this briefing, let it be this. In a currency reset, wealth isn't actually destroyed. It's transferred. It simply moves from the hands of people holding paper assets that can be printed into oblivion and into the hands of people holding real, tangible assets that can't.
Look, in the environment we're heading into, you have to stop thinking of gold and silver as speculative investments. That's not what this is about. They are your financial insurance policy, and they each play a critical role. Silver, think of that as transactional money for your daily needs if confidence in the dollar really starts to crack. And gold? That's about preserving and even growing your family's wealth through this entire reset. I mean, the dollar's already lost 97% of its value since 1913. These hard assets are your final line of defense.
The math is undeniable. The trends are crystal clear. This systemic reset isn't a question of if it's going to happen, it's only a question of when. So the only real question left for you to answer is, when it happens, will you be on the right side of that great wealth transfer?
That $9 trillion wall isn't a theory. It's a date on the calendar. Join the Survivor Circle to make sure you're on the right side of the reset. Subscribe now. Because the crowd, they won't see this coming until the ATM stops working. The time to prepare isn't tomorrow, it's right now.